Hello, it's Tim Moffat here from Oakleigh Investment Management. I'm sitting with Akil Patel, one of my co-investment committee members. We're here at just after the end of second quarter 2026, having rounded out a pretty interesting year. I guess it's always interesting, but certainly a good year for us and our investors and the global share market generally, not so much the Australian share market. Sitting here watching a few of the trees nearly blow away. I'm about to have some ramping up to gale winds. I think, Akil, you've been in London sweltering through some 40 degrees, which I assume has been horrible without air conditioning. Hopefully that's eased off for you.
Yeah, it's been quite an interesting few weeks. London is certainly not the place to enjoy 40-degree weather. But yeah, it's been kind of more turbulent weather than perhaps in the markets. So since the announcement, at least of the deal in Iran. So yeah, been interesting times.
Look, I think taking a step back in terms of looking at everything through the real estate and banking cycle lens, I think it's pretty clear where we are. You know, we have elevated private debt, even elevated public debt. We've got deteriorating underlying economy, although there are certainly pockets of strength in like AI construction and data center construction. We're seeing consumer sentiment deteriorate quite markedly. In Australia, business sentiment's doing the same thing. We've seen mounting private credit stresses and incidents, private credit funds closing their doors, gating investors, problems just kind of ticking away or bubbling away in the background there. Second-tier lenders in Australia have, even last week, not imploding entirely, but we've got bad debts and issues popping up that we haven't seen in a while. And we're seeing a cooling land market. I mean, certainly in Australia, it's very obvious, but even in the US, especially if you look at it with an inflation-adjusted lens. So at the same time, we've got frothy markets, record valuations, but record IPOs. I mean, I think the SpaceX IPO was on something like 90 times sales, not 90 times profit, 90 times sales, which I think, Cisco at the height of the dot-com boom, I think was about 2.5 times, 3 times sales. So there's certainly, that's absolutely a new record there. In terms of market activity, the Korean stock market and the semiconductor index have absolutely flown since the bottom in March this year. They're up 100%, trading like meme stocks. We're talking about the total Korean market, not just a couple of names. So I think it was Templeton that said bull markets die on euphoria. I wouldn't say that across the board there's euphoria, but there's certainly pockets of it. And it seems to have moved. A couple of years ago it was Bitcoin. Maybe last year it was some precious metals, and now we're in semiconductors and tech stocks. Now that doesn't mean that it's all over now and it's the end of the line. I mean, if you go back to the most extreme example, 1920s, the land market peaked in 1926, and from that point, the Dow basically doubled and then almost doubled again in its peak in 1929. So you have to look at this through the lens of anything can happen. Just because valuations are more stretched than they've ever been doesn't mean they can't get worse, certainly in the short term. So from our point of view, where does that leave us? I think it means we're looking at things like the markets on borrowed time. It might have a few more years left, it might not, but we know we're somewhere near the end, and the focus on capital preservation over growth is paramount. So what happened during the quarter is positions that deteriorated continued to get liquidated, and by the end of the quarter, the portfolio was roughly half cash and bonds, defensives, and half growth assets like shares. The goal really is to keep our head and stay focused on that and on capital preservation. And if it means we're going to miss a few hot sectors or stocks in the near term and and have some underperformance, then I think so be it. That's just a matter of prioritising what we're doing here. And that's, I guess, the focus on capital preservation, keeping the portfolio invested aligned with the cycle, which is the mandate.
Yeah.
Probably a good example of that would be our gold holdings. We've made the portfolio has performed very strongly, and part of that is the back of our gold holdings over the last 12 to 18 months. Towards the back end of 25 and early 26, we had taken a lot of profit out of that sector, but we still held core positions in global gold miners and physical gold. We actually added to that position in early May on a possible higher low, but not long after the whole sector and the physical broke down, and we used that as effectively a trigger point to fully exit on that failure. And that was really just continual focus on capital preservation. Now, in the short term, in hindsight, that's been the right call. That's down another 10% since we exited. So I think, and maybe you can step in here, I think we're both of the view that the gold market may continue to run again. It may not all be over for that sector, but certainly in the short term, if you take a little bit of a step back, the spot gold price is $2,000 an ounce not that long ago.
Yeah,
got up to nearly 6,000. It's now 4,000. Halfway between the low and the high is roughly 3,600. So I think, it's a matter of just keeping an eye on that sector and waiting for it to turn before we want to consider jumping back in.
Yeah, I think that's right. I mean, the run is over for the time being. I think we've communicated this to some of our clients and some of the other things that I've said publicly and also to my subscribers is that the kind of relationship between gold and the end of the cycle is quite an interesting one, particularly when you get to the really peak part of the cycle and then the onset of crisis. I think there is indeed a flight into gold, partly because there's very significant concerns about the health of the financial system. But until that point, you do get sort of fairly significant runs such as we've had, and then periods of what I think are consolidation. So I think we just wait for the markets to give us the next signal. I think we can afford to be patient, and I'm very pleased to see that we took advantage of the very strong run to the peak at the start of the year. And I do believe that it will play a role in the portfolio going forward. But for the time being, I think there's some consolidating to do, some unwinding of, no doubt, a highly leveraged investments on the run up to the peak, and various other kind of issues in the some broader financial system vis-a-vis gold. So while that all plays out, I think it doesn't need to have a place in our portfolio.
Absolutely. The gains that we've made over the last couple of years, we really focused on preserving those. So how that translated in this quarter, the portfolio was down 1.5–2%, and that was against an MSCI or global stock market that was up 13%, which is quite incredible out of the early March lows, late March lows.
Those damn AI stocks.
Yeah, again.
Unfortunately, not too many of those in Australia.
No, there's none. We don't have any exposure to that sector. So from a relative sense, in the short term, that's impacted us. The All Ords, the Australian market, was up roughly 4%. So certainly nothing like what was seen globally, and that was because really most of those technology stocks are in the US and such a huge part of the index so globally now. So if you just take a little step back further, though, from the quarter, over a 12-month period, the portfolio is up over 30% versus the MSCI, the stock market up 20%, and the All Ords, including dividends, of 6%. So materially ahead there. And I guess it really, from our perspective, over the quarter, we continually exited some of those underperformers, and the cash levels continue to raise, focusing on that capital preservation. So, I guess the reality is, if the current thematics continue and we keep seeing this tech sector go from expensive to crazy expensive to something
There's
else
no word for
even,
it, really.
even more absurd. It just is what it is. You know, we're not prepared to play that game. Really,
Yeah.
we're here. We're not ready to chase the last leg of a market that's starting to look euphoric. And we're comfortable with that at this point in time.
Yeah, absolutely. You basically invest in what you have available, but using the signals that we have. And I think, you know, as we've seen, when there are pretty strong runs in sectors, we have the ability to take advantage of those. And in between times, I think it's important not to be emotionally tied to a particular narrative or a sort of hype, albeit, you know, very strong paper performance for a lot of investors. But I think we've seen in recent weeks with some of the reactions of, for example, Nvidia and other you know, pure AI kind of stocks, that the reactions to you know, slightly less growth in earnings, indeed in terms of the reporting by other companies, has been quite interesting, and it does suggest that you know, some investors are quite jittery about that. So we don't want to get caught up in all of that volatility, which is based upon a grand story, based upon hype. It's not necessarily linked to the, at the moment, very strong fundamentals. So I think we're taking the right approach there.
Yeah, absolutely. Okay, great. I think that's a good, quick snapshot. Keeps everyone up to date with how we're looking at the world. Let's aim to circle back in another 6 weeks, halfway through this quarter, and see how things are developing, and take it from there. Obviously, if you're watching this and you're not an investor and you're interested, you can find more information on the website, oakleighfs.com /OIM, Oakleigh Investment Management, or you can just email admin at Oakleigh FS and just ask for somebody to reach out and contact you for more information. Thanks, Kill. Appreciate your time. We'll talk soon.
Thanks very much.